We continue to see stocks push higher here on this election day. The Dow is now up 2.5%. So at the highs of the session is where we're seeing the major averages at the moment. But will they stay that way? What's going to happen after the election? What has happened after elections in the past? Brian Cheung is here with a special edition, a special election day edition of Yahoo U to tell us what we have seen before. Brian.
Well, Julie, class is in session, and most of our viewers are asking the same question that they always ask, regardless of what the big news of the day is, which is, what does it mean for stocks? Well, as with everything, it's a little bit more complicated than that, and that's because of all the possible outcomes, including one where we don't even know the outcome by the end of this night. But let's unpack the data. I want to show you some data that comes from a Citi Private Bank via Haver. And what you're looking at here is whether or not there's a stock reaction to the incumbent president winning or not. So again, an incumbent winning the election, which is illustrated by the purple bar here, generally coincides with a stronger stock market in both the election year and the 1 year after election, about 12% each. And that's a pretty large gap between when the incumbent loses, which is in the blue bar here, which is substantially smaller, again, based on this Haver data from Citigroup. So on this basis, a Trump win tonight may be in line with expectations for higher returns. But of course, it's not just the presidential election that matters here. And we're also watching those Senate and House races as well. So buckle in, because the next chart is going to be a little bit of a mess here. But this comes from Fidelity, and this measures broad market performance across several measures. So this is the S&P 500 in addition to the Dow Jones. And what this shows here is the growth in stocks across the 48 months or 4 years after an election. So an entire administration, if you will. And the red lines, which are, they show you the different Republican leaning outcomes. So a presidential win, a sweep of both chambers, the Senate and the House, a Republican win of the White House, but a divided Congress. And then the blue lines here represent the same things, but just for Democratic leaning outcomes. And broadly speaking, any of these outcomes are going to result in pretty solid growth. I mean, you might argue that at the end of the administration, after 48 months, more of the Republican outcomes tend to lead to higher growth. But this is really too noisy of a chart to draw any sort of solid conclusions, right? You recognize any sort of stock market gains as of a time period, and across an administration, there are periods where it's not always true that a Republican administration leads to higher growth. But here's the bigger point, right? Take a look at the purple line here. This is all election outcomes, or literally exactly what the market does in any given 4-year period of time. And the conclusion here is that stocks usually go up. That's what Sam Rowe and Miles Udlin on this program frequently say. Stocks usually go up. So there's that. Now, as a separate question, which is valid specific to this election, what if we get a contested result? And obviously, our only comparison is really the 2000 election, Gore versus Bush. And this is the Dow Jones and the S&P 500, purple and blue respectively. The election happened on November 7th, right here. Now, that night, networks had called Florida for Gore, and then they retracted it. They called it for Bush. Then they said it was too close to call. You remember the whole story. At that point in time, markets were really starting to realize that this is going to get messy, and then you could see the resulting sell-off. In fact, if you look at the S&P 500, as of the 2 weeks after the election in 2000, we actually did see a sell-off as steep as about 8%. Now, there were legal battles, and then we didn't really get any sort of certainty until around here, December 12th. That was when that Supreme Court decision, the 5-4 decision, had really established that George W. Bush was the president over Al Gore. And by that point in time, we had, again, still seen some market sell-off. So I do want to note, obviously, this is a sample size of just one, but UBS noted earlier that markets abhor uncertainty. There's, the possibility that if there were to be a contested election, there could be some safe haven running towards assets like U.S. Treasuries or gold, things like that. So there is some volatility. But as I illustrated, is that really any more unusual than anything else that we see in normal market dynamics? Which is all to say, Julie, Miles, and Brian, that stocks are going to stock. That's just the way it goes.
Well, and Brian, of course, it warms my heart to hear someone talk about stocks usually going up. But I actually want to, the first chart that you brought up was interesting because it sort of speaks to, and this is something I wrote about in the morning brief today about, performance right before the election tends to predict what happens. But really, if you look at election turning points and you go through the last half dozen or so modern elections, it basically is about the business cycle, right? I mean, we could make an argument 14, 15 was sort of the recession that did happen or didn't register. I mean, 15, 16, right? Ahead of when Donald Trump won. Obviously, we know what was happening in 2008. Go back to 2000 when party control changed. That was in the midst of a recession. 1992 in the midst of a recession. 1980 in the midst of a recession. And so that incumbent winning line, it makes you realize if things are going well and the economy is doing well and stocks are going up, the incumbent tends to win. And I find these conversations so interesting because, okay, sample size of 1 is small. Well, so is the sample size of 6, right? I mean, we really kind of are all here talking around the idea that if the business cycle does well, if the stock market goes up, the incumbent wins. Otherwise, things tend to flip. Thus, the data point certain pictures that I think we can paint any way we'd like.
Yeah, and I think that's a pretty salient point that you bring up, which is that another way of thinking about it in the blocks is really 10-year increments, right? When you think about the last major recession before this COVID crisis being in 2010, and then you remember the dot-com bubble around 2000, 2001. So if you think about those 10-year increments, that's about 2 administrations and a half. So during those periods of time, I think markets generally like to know that there's not going to be a major change at the head of the largest, arguably most important government and state in the entire world during that period of time. So I think it has less to do with who's a Republican, who's a Democrat, which is a separate line of data that I actually was able to pull through Haver, but it didn't show anything interesting. In fact, the incumbent president winning is more important than whether or not the party is winning, whether that's Republican or a Democrat in a given election, which is why I showed you that, again, that 12% gain that you tend to see in the year after election really is more based on whether or not the person currently sitting in the office is going to stay in that office in January. Another interesting point, though, is that, again, it's not just the president. It really has to do with the balance in those chambers of Congress as well. If you did want to glean something from that noisy fidelity chart that I showed you, that second one, if you want to rewind to that, which, by the way, you can find that clip on Yahoo Finance, you might be able to notice a bit of a trend around the 24-month period, which means that that midterm election does tend to have some sway additionally on where the economy ends up going, or where the stock market rather is trading at that point in time. You can see that maybe the Republican divided Congress tends to lag in the first 24 months, whereas at the midterm election after that, it does tend to outperform. So you might glean some trends from there. But again, I think it's more about certainty more so than really who and what party is in the office.
Or maybe I'll come in and be the cynic and say, maybe you don't invest based on elections.
Yeah, no, that's probably the greater point here, because why? Stocks go up most of the time, of course, when they don't.
Stock's going to stop. Well, and when they don't, it's usually not because of politics.
Yeah, absolutely. And I think that that's the bigger point here, is that the question here is really, is it politics that drives stocks, or is it stocks that drive politics? One example is that within the context of this current 2020 election, there's a lot of chatter about the market really kind of getting ahead of where the election results will be. If it does look like it could be, for example, a Biden win, you might see longer-term U.S. Treasury yields, the 10-year, for example, start to creep up before there even is a declared winner here, simply because the markets will start to price in the odds of those stimulus or a larger stimulus bill after inauguration next year. That could present some real risk to whether or not the Federal Reserve will have to target its quantitative easing towards the longer end dated purchases. I won't get into that. I actually had already promised I wouldn't talk about the Fed in this hit, so I'm already violating the rules there. But again, I think that markets do tend to lead election or political related results, which I think is kind of a question of, should we do a Granger causality to that test to see whether or not it's markets that drive politics or politics that drive markets?
And just very quickly, it strikes me, though, as we're talking through all this, Brian, 3 decades ago in the 90s, I don't think people were thinking through this the same way. And so I do think there's a reflexivity here on the obsession of all the information we have, thus imputing motives to the market, which may or may not exist, mostly just because we have Twitter and this show to talk about.
Yeah, and we know that the U.S. president, right, does tend to look very, very close to the stock market. So there is a pretty clear path that you can draw between how stocks drive economic policy, at least under this administration.
And Brian Cheung, never promised not to talk about the Fed. Come on now. Brian Cheung, thank you very much. Appreciate it.